Welcome to the Deep Dive. Today we are wrestling with a company that, well, for nearly 2 decades, it stood as Wall Street's absolute favorite growth darling. Chipotle Mexican Grill.
Yeah, for years it just seemed to defy gravity in that whole fast casual space.
But recently, that narrative has really turned dramatic, and the stock is showing some serious cracks.
Oh, it's more than cracks. It's been a punishing fall. Chipotle stock is down roughly 30% year to date.
30%.
And the pain really intensified severely after its latest Q2 2025 earnings report. It plunged 13% virtually overnight.
Wow.
It's now kind of languishing, in the low 40s to $50 range. That's a devastating blow for a stock that commanded such high expectation.
And this volatility, it creates this profound conflict, right?
Yeah.
We sparked this really intense debate among analysts, among investors.
Definitely.
Is this volatility just a temporary discount on what's fundamentally a phenomenal business? Or is this the moment the high-flying growth story finally goes cold, as one of our sources put it?
That's exactly the core tension we need to resolve today. We have a pretty complex stack of material here.
Yeah.
Detailed financial models, the Q2 2025 earnings report itself, and importantly, sharply contrasting investor opinions on exactly what Chipotle is worth right now.
Okay.
So we really need to unpack this conflict and understand what the fundamentals, both the brilliant financial profile and the recent operational failures, what they truly suggest about the company's immediate future.
So our mission today is to distill all this information for you, the listener. We'll look at Chipotle's impressive historical performance, which is genuinely best in class.
It really is.
But we have to overlay that with its recent and very serious struggles, especially that sharp decline in comparable sales.
Yeah, the core issue is that the massive premium valuation the stock has historically commanded, well, it now sits on what feels like a dangerous air pocket beneath the share price.
Because the growth engine stalled.
Exactly, because the essential organic growth engine has sputtered.
Which brings us to the big question for you. How can a company with these best-in-class margins, a fortress balance sheet, huge projected growth potential, how can it suddenly see its core business customer traffic just stall? Or even go into reverse?
And if that growth has stopped, or at least paused, what valuation premium is actually justified for a company facing this level of, execution risk?
Okay, let's unpack this. Let's start with the bad news, the shocker.
Right.
So for a decade, maybe more, Chipotle was just defined by reliable double-digit growth. They were kind of the anomaly in fast casual, always delivering.
Always.
So what exactly happened in the second quarter of 2025 that caused such a severe market reaction? It wasn't just missing analyst estimates, was it? It felt like something bigger.
It absolutely felt like a fundamental shift. And the core problem, it's rooted in one metric that analysts track religiously, comparable restaurant sales, comp sales.
The big one.
Yeah, for Q2 2025, comparable sales decreased by a painful, some called it startling, 4.0% year over year.
Yeah.
And this is the metric, that proves if the existing stores are getting better or worse.
A 4% decline.
Yeah.
I mean, in the restaurant industry, that's like a flashing bright red warning light, isn't it?
It is. It signals that all the effort, the marketing, the menus, the operations in existing stores, it just failed to keep pace with last year.
So why? What drove that?
Well, if you dig one layer deeper into the report, you see why that comp sales decline happened. The drop was driven almost entirely by a 4.9% decline in transactions.
Almost 5% fewer transactions.
Yeah. It means nearly 5% fewer people are visiting or ordering from their established stores compared to last year.
5% fewer customers. That is brutal.
It is. Now, that transaction decline was partially offset by a tiny 0.9% increase in the average check.
So people paid a bit more.
A tiny bit more per order, yeah. Almost certainly due to the price hikes they put through in 2024, but clearly it wasn't nearly enough to stem the tide of disappearing transactions.
But wait a second. The total revenue number wasn't down 4.0%, right? So you said it grew.
That's the critical distinction. Total revenue did grow, but only by a modest 3.0%. It reached $3.1 billion for the quarter.
Okay.
However, as our sources point out, the only reason for this top-line increase is that Chipotle is still aggressively expanding. They opened 61 new restaurants in Q2 2025 alone.
61. Okay, so if you strip out the revenue from those brand new stores,
Exactly.
the organic growth engine, the measure of how productive their, vast existing store base is, it hasn't just stalled.
It's gone into reverse.
It's gone backwards. Wow. So the company's growth story is now entirely reliant on just building new restaurants to paper over the decline in traffic at the old ones.
That is the perfect summary of the Q2 problem.
Yeah.
It fundamentally changes the investment thesis, from this high growth, high volume story
Right.
to basically an expansion only story, at least for now.
And what did that do to profitability? I mean, you can't lose that much traffic and suddenly start spending heavily on new openings without it hitting the bottom line.
No, the profit hit was immediate and measurable across several key metrics. Despite that modest revenue increase from new stores, the overall operating margin, it dropped from 19.7% last year to 18.2%.
Okay.
And maybe more concerning, the restaurant-level operating margin, that's kind of the gold standard for measuring store efficiency, it also dropped from a really stellar 28.9% down to 27.4%.
Let's pause on that margin compression for a sec, because that's really vital. Why did both margins suffer? Is it just the traffic loss or is something else going on?
Well, it's a direct interplay. It's the traffic loss, absolutely. When transactions decline, your fixed costs, like labor and rent, they get spread across fewer orders. That instantly drags down margins.
Thanks, Ev.
But that margin decline was made worse by the second punch management's reaction, which was basically to flood the market with costly promotions later in the quarter.
Ah, the promotion.
Yeah. And diluted earnings per share EPS that confirmed the pain. It was down 3.0% year over year from every $1.33 to $1.32.
So that's the hard evidence that the high-volume organic growth story is, well, cracked.
Cracked is a good word for it.
Now let's talk about the communication. How did management try to, sell this tough quarter? Spin it.
Well, management definitely attempted a highly optimistic narrative during the earnings call. The CEO commentary focused heavily on a supposed momentum build throughout the quarter.
Momentum build.
Yeah, and claimed they saw a return to positive comparable sales and transactions in June. The messaging was very much focused on implying, hey, the worst is over.
But investors read the guidance,
Yeah.
right? Not just the spin.
Yeah.
And the guidance, that was the second punch that really made the stock crater.
Absolutely. Management was forced to dramatically downgrade its full year 2025 comparable sales guidance. They had previously guided for low single-digit growth back in Q1.
Yeah.
But after seeing the Q2 struggles, they revised that outlook sharply downwards to about flat.
Wait a minute, hold on. The CEO just told investors they saw a return to positive momentum in June.
Right.
If they genuinely believed that momentum was sustainable, why on earth would they downgrade the full-year guidance to about flat? That's basically telling the market they expect zero organic growth for the next 2 quarters.
Yeah.
Doesn't that seem like a massive red flag? Like they don't actually trust that June momentum themselves.
It's the definition of a credibility gap, yeah. The revised guidance implicitly suggests management either anticipates significant, persistent macro headwinds or they believe the recovery they saw in June is highly dependent on conditions they just can't sustain without crushing margins further.
Okay, and this leads us right to this concept of the marketing treadmill. Why was June looking better? It wasn't just natural demand coming back, was it?
Oh, definitely not natural demand. The limited recovery management cited in June was directly tied to really heavy promotional activity, like a frantic barrage of marketing blitzes, as one source described it, designed purely to drive people back into the stores.
Okay, tell us about those promotions. What were they spending money on to try and buy back that traffic?
It was an aggressive spend. This included launching the Summer of Extras program,
Right.
literally giving away $1 million in free burritos.
$1 million in free burritos.
Yeah. Heavy, BOGO, buy one, get one deals. And rolling out new, heavily marketed products like that Adobo Ranch dip. This kind of promotional blitz is expensive. And it raises a really worrying question about the long-term health of the brand.
So the critics basically view this as buying revenue at the expense of profit margins, right?
Right.
You're trading a discount now for volume, but maybe damaging the premium perception down the road.
Absolutely. This raises serious concerns about long-term brand equity erosion. You're effectively training your customers who are already questioning the price to portion value to only visit when they get free food or a big discount.
Yeah, that's dangerous.
It is. As one analyst noted, a return to positive sales driven by heavy discounting is not the same thing as a return to organic demand-driven growth based on product superiority and value. It's reactive, it's expensive, and it risks cementing the brand's perception as just another coupon-reliant chain, which, historically, they definitely were not.
Okay, so that sets up the central conflict just beautifully. We have this severe operational deceleration, profit margin pressure in the short term.
Right.
But the bull case, and probably the reason the stock hasn't collapsed entirely, rests on the company's, well, brilliant financial profile, and historical performance.
It is brilliant, yeah.
Let's dive into those fundamentals that keep investors hooked, starting with their, astonishing store-level economics.
Okay, yeah. When we look at Chipotle's unit economics, we are looking at something genuinely exceptional, likely the best in the quick service restaurant industry, full stop.
Really? Best?
Arguably, yes. This is where the competitive moat, theoretically, should be the widest.
So tell us specifically what makes their economics so incredible.
It's the sheer efficiency of their capital deployment. New locations, right? They are realizing year 2 cash-on-cash returns around 60%.
60%.
60%. This is basically unheard of for a business that requires significant physical build-out, like a restaurant.
Okay, just to explain that clearly for the listener, that means if Chipotle invests, say, $1 million to open a brand new restaurant,
Right.
by the second year of operation, that restaurant is expected to generate $600,000 in pure profit or cash flow. That's an extremely fast payback.
Insanely fast payback. And it gets even more impressive when you look at the established estate, the older stores. The overall cash-on-cash return across the entire mature base stores open longer than 2 years sits in the low 80% range.
80%?
Yeah. This is the detail that truly separates them from basically everyone else.
Okay, give us some context here. How does 80% compare to competitors?
Oh, it's a huge gap. Fast food chains like McDonald's or Wendy's, they typically target maybe 20% to 30% returns on their capital investment.
Look.
Fast casual peers, the Subways or Paneras of the world, they might aim for 25% to 40%.
Right.
The fact that Chipotle can achieve a consistent 80% return on invested capital across their mature base, it just highlights an incredible competitive edge in unit efficiency. This thing is a machine that prints cash when it's run correctly.
And that efficiency, it translates directly into those market-leading margins, which, as you said, were still high, even in a bad quarter like Q2.
Absolutely. Restaurant-level margins consistently sit over 25%. Even when they were struggling in Q2 2025, that margin remained 27.4%.
Still 27.4%?
Yeah, which is significantly higher than fast casual peers. They're typically seeing margins between maybe 15% and 20%. And even established fast food chains usually hover around 20% to 22%.
So why? Why is this gap so persistent? Why can Chipotle keep margins so much higher than everyone else?
Well, the sources attribute this advantage to 2 main structural factors. First, the non-franchise model.
They own all the stores.
Right. Because they own every store, they maintain far tighter control over operations, cost structures, execution quality. There's no variance or quality drop-off because of different franchise operators running things differently.
Makes sense.
Second, and this is really key, the simple menu structure. Burritos, bowls, tacos, salads. It's incredibly efficient. It reduces kitchen complexity, minimizes food waste because you have fewer ingredients overall, and it streamlines training. All of that leads to lower overhead and faster, higher volume service.
Okay, so that control allows them to command higher prices while keeping costs tight, which brings us to the balance sheet. This is often cited as like a fortress.
It is pristine.
Yeah.
And this is where the bull case really gains its most stable footing. The company holds $2.1 billion in cash and investments.
Billion, with the B.
$2.1 billion. And carries no long-term debt in the traditional sense. Zero.
Wow.
This strength allows them to fully self-fund their aggressive expansion plans without relying on external financing, which is a huge strategic advantage.
But I noticed one source pointed out a seemingly high debt-to-equity ratio, something like 135%. That sounds alarming if they're debt-free, unless you understand the accounting rules.
Yeah, that's a really important point for clarification. It's a detail often misunderstood by, non-accountants just looking at the raw numbers. That high debt-to-equity ratio is directly attributable to the new lease accounting standards, specifically ASC 842, which was implemented a few years ago.
So, okay, essentially, we aren't talking about bank loans here or corporate bonds, the stuff we normally think of as debt.
Yep.
We're talking about the long-term cost of rent for all those stores being put onto the balance sheet as a liability, which makes the debt ratio look scary when it's just an accounting convention.
Precisely. ASC 842 requires companies to capitalize their long-term operating leases, basically, the obligation to pay rent over the next decade or more on the balance sheet as a liability. This artificially inflates the debt-to-equity ratio, even though the company is functionally debt-free and very liquid in the traditional sense. It's an accounting nuance, not a sign of financial instability.
Okay, that context is absolutely crucial for investors. Now, let's look at the financial performance metrics, the ones often cited as textbook examples of perfection.
Right, we're talking about return on invested capital, ROIC, and return on equity, ROE. Chipotle's ROIC, which measures how effectively they use all their capital to generate profit. It's shown this consistent upward trajectory. It grew from 7.48% in 2019 to an impressive 21.24% in 2024.
That's huge growth.
It confirms their remarkable efficiency in utilizing cash flow. Similarly, ROE, which measures profitability relative to shareholders' equity, reached 40.13% in 2023.
40% ROE.
Yeah, these numbers just confirm that management has demonstrated real excellence in deploying capital to deliver outstanding long-term returns.
So, okay, they have a flawless financial base. The main lever they seem to be pulling now to combat that comp sales decline and keep showing revenue growth is expansion, the outbuild the problems playbook.
That seems to be the strategy, yeah. Despite the headwinds, management remains committed to opening 315 to 345 new stores in 2025. And crucially, they are strategically focused on a key innovation: Chipotlanes.
Chipotlanes, those are the drive-thrus, right?
Yes, exactly. And they seem to be strategic gold for them. Over 80% of these new stores will feature Chipotlanes.
Why so many?
Because they're proven performers. They enhance guest access. You don't have to get out of the car. They increase new restaurant sales significantly, and they boost both margins and overall returns, largely by catering to that explosive growth in digital ordering.
Okay. And what about the long-term vision? The growth runway isn't just about this year's 300-odd stores, is it?
No. The domestic growth runway alone is massive. Management targets 7,000 stores in the U.S. and Canada. That's roughly double the current store count of just over 3,800.
Double. Wow.
And beyond North America, they are in the very, very early stages of international expansion. That provides a potential multi-decade growth lever. They currently have 5 licensed restaurants in the Middle East. And more recently, they signed a crucial partnership agreement with Alsea, a major Latin American operator, to enter the high-potential Mexican market. The first restaurant there is anticipated in early 2026.
That international opportunity is significant. If their unit economics hold up even partially abroad, that alone could power growth for decades.
Potentially, yes.
So, okay, we have this unparalleled financial machine.
Yeah.
But in Q2, that machine started sputtering because, well, the customer left.
Yep.
All right, here's where we pivot back to the problem, the one that drove the stock down 30%. The financial engine is robust, sure, but the customer experience, or maybe the perceived value, seems to be deteriorating. And that led directly to that crucial 4.9% transaction drop.
Yeah.
So why? Why are consumers who are central to the entire business model, suddenly voting with their feet?
Well, it really boils down entirely to a weakening value proposition. It's that classic trade-off where the customer just feels like they're paying more and getting less.
Paying more for less.
Exactly. We have some direct anecdotal evidence from our sources that really illustrates this point perfectly.
Okay, let's hear that anecdote. Sometimes those make the abstract numbers feel more tangible.
Right. So one of our sources, a loyal customer for over 10 years, described his typical order: a steak burrito with guac on the side. Pretty standard.
Yep.
He broke down the numbers. He noted that the price of that exact order had increased from about $10 to $13 over just the last 12 to 15 months.
That's a 30% hike?
Yeah, a huge increase. And simultaneously, he noted a distinct, maybe subtle, but noticeable decrease in portion sizes being given out by the staff.
Ah, the double whammy.
The double whammy.
Yeah.
So the company is effectively, nickel and diming the customer in 2 ways at once, charging significantly more and subtly delivering less food. That's the classic value killer right there.
It really is.
Exactly. And this combination of higher prices, lack of perceived generosity, it's pushing away core customers. The source provided a really vivid comparison point that kind of crystallizes the problem.
What was that?
He pointed out that a full restaurant dinner, like a burger, a side, maybe an appetizer, and a drink at a casual dining chain like Chili's, can often cost less than a single premium Chipotle burrito these days.
Wow. When a fast casual quick service meal starts costing more than a full sit-down experience.
The value calculus completely breaks down.
Yeah. And this erosion of value, it sounds like it's allowed competitors to successfully launch what you called earlier a competitive pincer movement. Squeeze from 2 sides.
That's right. First, you have the fast casual skirmish. The direct rivals are getting aggressive. They're eroding Chipotle's traditional differentiators and really attacking their value weak points.
Okay, give us some examples. How are direct rivals competing on value specifically?
Well, take Qdoba, Arguably their most direct rival in that high-quality burrito space. Qdoba doesn't charge extra for guacamole or queso.
Ah, the free guac.
The free guac. That immediately eliminates a major pain point for Chipotle customers who really resent paying, what, $2, $3 extra for guac.
Yeah.
Meanwhile, Moe's Southwest Grill offers free chips and salsa with every single order. That instantly boosts the perceived value of their meal relative to Chipotle's base price. The whole concept of high-quality, customizable Mexican food is just, it's not unique to Chipotle anymore. The rivals have caught up on quality, and now they're starting to beat them on these value adds.
Okay, so that's pressure from direct competitors.
Yeah.
And then you have the pressure from below. The fast food pincer targeting the price-sensitive buyer.
Exactly. This is Taco Bell, the massive behemoth with just unbeatable scale and pricing power. Now, historically, Taco Bell was seen as lower quality ones.
Sure.
But Taco Bell has spent years narrowing that quality gap, particularly with some of their higher-end offerings. That makes them a highly attractive alternative for price-sensitive consumers, and this pressure gets amplified during periods of weakening consumer spending and high inflation, like we've seen.
Right.
So Chipotle is at serious risk of losing the most value-conscious consumers to fast food and simultaneously losing the savvy, quality-conscious consumers to its direct rivals who offer better value adds. It's a tough spot.
It really is. This raises a critical question about Chipotle's moat, their competitive advantage. They built their brand on food with integrity, which is powerful, especially with millennials and Gen Z.
Very powerful brand equity.
But is that enough of a competitive advantage anymore to justify the premium price, given these pressures?
Well, the sources suggest the restaurant industry moat in general is pretty narrow. It relies really heavily on flawless execution, consistency, and critically brand trust. It's not like they have patents or regulatory capture protecting them.
Right, no tech secrets here.
Exactly. Chipotle's brand equity is powerful, yes, but its vulnerability is that customer switching costs are virtually zero.
You just walk across the street instantly.
Exactly. A $1 price difference, a perceived decline in portion size, or, God forbid, a single food safety incident. Any of those could easily destroy that fragile customer loyalty and brand trust that they've built up over years. The value proposition is really the primary defense, and when that starts to falter, the moat just dries up fast.
And critics argue that management's focus right now is maybe entirely misplaced. If the core business is bleeding transactions, why are they spending money on, marketing gimmicks instead of fixing the fundamentals?
Yeah, the critique is sharp. Management is relying too heavily, some say, on these short-term marketing blitzes. You mentioned the Roblox games, the Snapchat lenses, launching the Adobo Ranch dip,
Right.
and the aggressive expansion of Chipotlanes. Now, expansion is vital for long-term profit, no doubt, but it fails to address the most urgent short-term need: fixing the value proposition and stemming the customer outflow at the huge base of existing stores.
So they're focusing on a periphery, maybe, while the core business is bleeding.
That's the argument.
Yeah.
Bleeding transactions and customer confidence. #Trag4. The valuation conundrum and investor strategy.
Okay, here is where it gets really interesting, right?
Mm-hmm.
Because we have this paradox. A fundamentally excellent business, almost unmatched unit economics.
Yeah.
That is currently bleeding customer traffic because of what sounds like a self-inflicted value crisis.
Right.
So how should investors even begin to calculate the fair value for a company caught between this operational perfection on one hand and execution failure on the other?
This brings us squarely to what we're calling the premium dilemma. Historically, the market has just been willing to pay a massive premium for Chipotle. Why? Because it was viewed as this disruptive, unstoppable growth story.
Right.
The average price-to-earnings ratio, the PE ratio, over the last decade was around 77.
77 times earnings. I mean, that is an astronomically high multiple, usually reserved for early-stage tech companies, not a restaurant chain selling burritos.
It is, and that premium essentially meant investors were pricing in perfection. They were assuming zero execution risk. It was almost a psychological valuation, not purely financial.
Okay.
And even after the recent 30% drop, the stock is still trading at a high multiple. Somewhere between 35x based on one video analyst's calculation we looked at,
Okay, 35x.
and maybe 45x based on another analyst, Darius Dark's estimate using forward earnings projections.
So still very high. I mean, a 35x PE is typically reserved for companies expected to grow earnings by, 30% to 50% per year?
Easily, yeah.
But Chipotle's revised guidance suggests flat comparable sales for the entire year.
Right.
So the danger here is what they call a fundamental re-rating, isn't it?
That's exactly the risk. If the market shifts its view, if it stops seeing Chipotle as a growth juggernaut and starts seeing it as, say, a mature restaurant chain with significant execution risks,
Right.
that PE ratio could compress dramatically, maybe towards the 20s, which is more in line with established mature peers like McDonald's or Yum Brands.
And that compression alone.
That compression alone would imply a further substantial drop in the share price, potentially another 30% to 50%, even if earnings just stabilized. The premium is the risk right now.
Okay, let's dive into the conflicting valuation models in our sources, because we have two distinct camps here, right? First, the value investor stance, represented by analysts like Justin from JM0NEY. They suggest the stock is currently, well, wildly overvalued.
Correct. This model is based on hard, long-term, discounted cash flow analysis. Justin calculated an intrinsic value of just $39 for the stock.
$39.
39. Based on projecting, pretty healthy long-term growth, 11% in revenue and 14% in operating income through 2029. But even with that double-digit growth assumed, the business today fundamentally is worth around $40.
And crucially, for a strict value investor, $40 is way too close to the current trading price, like $50 to justify buying. They need that margin of safety.
Absolutely. Because of the inherent execution risk right now and the required margin of safety, his personal buy-in price is much, much lower, in the mid to high $20. Specific models he ran suggested buy targets ranging from as low as $16 up to maybe $28. So for this camp, the conclusion is clear: wait. Wait for the price to actually reflect the risk. Monitor the comparable sales recovery, sure, but don't rush in anywhere near the current $50 price point.
Okay, then you have the second camp.
Yeah.
The quality compounder stance,
Yeah.
represented by Invest Insights. They recognize the excellence of the underlying business. The high ROIC, the margins, but they still struggle with the current price tag.
Exactly. This viewpoint acknowledges that the current premium, let's call it 45x earnings, is undeniably rich, but they argue it could be justified, but only if the company continues to deliver mid-teens earnings growth with basically zero room for error.
So they're paying for quality, but the price demanded for that quality is just punishing.
It is.
What growth assumption are they using to justify that 45x multiple, especially when the value investor used 11% revenue growth and got $39?
Well, they're banking heavily on the expansion story. The 300-plus Chipotle openings per year. They believe that can drive sustained 15% plus earnings growth over the next 5 years, essentially offsetting the current comp sales dip at existing stores.
Okay.
Based on that, they set a target price of $65 by the end of 2027, which assumes a still rich 38x multiple then.
But even that target doesn't really work for them, does it?
That's the catch. Falling at the current price, say around $50, even if it hits their optimistic $65 target in 2027, that only yields an 8% compounded annual return.
8%.
Yeah. And since their minimum required return for a high-risk growth stock like this is 12%, the price is simply too high even for them. Therefore, they calculated they would only consider buying if the price dips below $47.
So even the bullish quality investors admit the price is too demanding right now, offers insufficient risk-adjusted return.
That's the takeaway. Both camps, for different reasons, are saying too expensive right now.
Okay, finally, let's look at the capital allocation scrutiny. While the stock was plummeting, what did management actually do with their precious cash reserves? That $2.1 billion.
Right. Well, in Q2 2025, Chipotle spent a colossal $435.9 million repurchasing its own stock.
Wow, nearly $500 million.
At an average price of $50.16 per share. And this is what critics are calling questionable capital allocation.
Why criticize it? I mean, returning capital to shareholders, buying back stock, that's usually seen as a positive sign, right? Shows financial health.
It's generally positive when the stock is clearly undervalued. It's much more questionable when the stock is still trading at, say, 40 times earnings, even after a drop. Critics argue that management spent nearly $500 million to repurchase a richly valued stock, essentially, maybe propping it up to prevent further collapse, when that capital could have potentially been far better deployed elsewhere.
And what were the better uses of that $500 million, according to the critics?
Well, they could have significantly invested in fixing the value proposition that's hemorrhaging customers. Maybe reducing the guac upcharge for a while or offering a compelling bundle deal to drive transactions back up. Alternatively, they could have accelerated the promising but still tiny international growth initiatives. Those arguably offer a far greater long-term return on capital than buying back shares at such an expensive valuation.
So it looks less like prudent management focused on core value.
And maybe more like management focused on stabilizing the share price in the short term. That's the criticism. Hashtag takeout outro.
Okay, so we have really established a deep paradox here. Chipotle is, on one hand, an operational marvel, nearly unmatched unit economics, debt-free fortress balance sheet, massive long-term growth potential in Chipotle lanes and international markets.
Not true.
Yet, simultaneously, it is struggling deeply with a core customer problem, value perception. And that has caused transaction declines that have basically broken the organic growth story and forced management onto this risky promotional treadmill.
Yeah, the immediate future looks challenging. The Q2 results signal persistent macro headwinds. Management themselves are anticipating flat comparable sales for the full year 2025.
Flat is not good for a growth stock.
Not at all. And that positive spin about momentum build, it seems highly dependent on costly short-term promotions that just erode margin and potentially brand equity. So investors really have to decide whether the undeniable long-term high margin potential of Chipotle's and that 7,000 store target, is it enough to forgive the current decay in the core business? The loss of customer traffic at existing stores.
It really is a classic test of, time horizon and risk tolerance. And for you, the listener, here is a provocative thought to chew on, building directly on the risk factors we discussed.
Okay.
We saw that Chipotle's moat, such as it is, relies heavily on execution and brand trust, factors easily damaged by perceived nickel and diming, the price hikes, the portion cuts. So if you were the new CEO facing this flat growth forecast, what would you prioritize? Would you go for aggressive expansion, the proven profit driver that utilizes those exceptional unit economics? Or would you focus on restoring the value perception, fixing the lost customer traffic driver, the core execution problem?
Knowing
that one single food safety incident could wipe out years of effort in either direction and fundamentally compress your valuation multiple overnight.
that is a tough choice. Expansion or fixing the core?
We'll leave you with that question to mull over.